Navigating stormy waters. Strategy and resilience at Samson International PLC. I am Pramudita. Now we will dive into business strategy and execution of this leading rubber and PVC manufacturer in Sri Lanka. Let's begin. Samson International PLC, founded in 1988. Samson International PLC is a listed subsidiary of the DSI Samson Group with over 450 employees. The company operates 3 plants, Galle, Kalutara, Baddegama, and export to 35 countries. Its main product line include molded rubber goods, PVC pipes, and value-added polymer items. Despite recent challenges, it continued to be a top exporter and innovator in Sri Lanka's manufacturing landscape. Navigating an uncertain environment, Samson faced a double shock from the Sri Lankan and European economic crisis in 2023-24. Supply chain disruptions, rising energy costs, and exchange rate volatility hit profitability hard. Festive highlights include political instability, inflation, and environmental pressures. SWOT reveals strengths like branding and certifications, and weaknesses like falling export and aging infrastructure. Opportunities include green tech, Asian market, and threats include raw material and currency risk. Samsung's strategic focus, strategic pillars, agility, innovation, branding. The company's current strategy is centered on three themes: agility, innovation, and branding. Agility means adapting to volatile global markets. Innovation is driven by the strong R&D pipeline, 14 new rubber product launch. Branding is emphasized through award and global certification like ISO 14001 and FSC. Samsung also segment its markets by product type, geography, and customer relationships to stay competitive. How strategy is executed. As we move into the heart of Samsung's strategic execution, it is important to understand how the company has responded operationally to the challenges of the past year and how these efforts align with long-term financial sustainability. First, Samsung invested 126 million rupees in renewable energy with a strong push towards solar and biomass energy integration. This included a second solar project at the Baddagama PVC plant targeting lower electricity dependency and cost saving in the medium term. These capital expenditures were carefully chosen not just for environmental responsibility, but to directly cut utility costs that have historically impacted margin. Second, in response to global demand shocks, especially from the EU the company undertook market realignment, actively reviewing with actively reviewing its export mix and adopting more flexible pricing strategies. This move aimed to preserve revenue streams and reduce dependency on declining or volatile markets. While export fell 26% in United States dollar terms, this pivot sets the stage for recovery through diversified and more profitable regional partnerships. Third, despite the challenging year, Samsung retained over 98% of its workforce, which not only reflect the company's HR strength but also avoid the retraining and rehiring costs that would arise from high turnover. This stability supports both operational continuity and brand value in quality sensitive international markets. And finally, company also expanded its storage and production capacity, especially in PVC segment, to better manage inventory, reduce lead times, and capture future demand efficiently. These infrastructure upgrades contribute directly to long-term cost efficiency and strategic readiness for market rebound. So while the bottom line for 2023-24 showed a net loss, the operational action reflect proactive investment in future profitability, balancing short-term turbulence with long-term gains through strategic execution. Key financial highlights. Let's now take a closer look at Samsung International's financial performance for the fiscal year to 2023-24, an undeniably challenging year that tested both financial strength and strategic resilience. The company reported a revenue of 2.3 billion, marking 20% decline compared to the previous year. The construction was largely driven by depressed demand in key European markets as well as foreign exchange constraint in Sri Lanka that impacted material procurement and export cycles. Perhaps most concerning was the company's net loss of 294 million, the first recorded loss in over a decade. This reversal from a profit of 93 million in 2022-23 is a strong indicator of the external shocks and operational cost pressures Samsung had to absorb. The return on capital employed, or ROCE, fell sharply to negative 51.4% from a positive 10.3% the year before. This suggests that capital investment during the year did not translate into sufficient returns, a red flag for any capital intensive manufacturer. Additionally, earnings per share dropped to negative 69.60, reflecting diminished shareholder value in the short term. Export revenue, which is a vital income stream for the Samsung, also fell by 26%, amounting United States dollar 3.5 million. While these numbers raise clear concerns, it is important to note that the management has not stood still. Strategic investment in solar energy and market realignment initiatives are aimed at long-term stabilization. What we see here is a short-term financial setback in the context of long-term capability building. In summary, the numbers this year show Samsung under pressure, but not without a plan. The financial downturn is being used as a platform for transformation strategy and operational realignment, with a clear focus on sustainability, cost efficiency, and market diversification. When I talk about deeply recommendation and conclusion, as we conclude this strategic review of Samsung International PLC, it is clear that resilience and transformation are essential themes moving forward. Based on the analysis of their recent challenges and execution capabilities, here are my strategic recommendations, all of which align with the company's urgent need to return to financial stability and long term value creation. First, Samsung should expand its digital B2B presence, and particularly in growth markets such as Middle East and South Asia, by investing in e-commerce platforms and targeted digital marketing. They can reduce dependency on traditional export channels, speed up client acquisition, and cut overhead. Key levels for the margin recovery after this year's 294 million rupees net loss. Second, it is time to elevate the Samsung's rubber brand locally, which year of export credibility and quality certification under its belt. Leveraging domestic market awareness through sustainable branded product can generate stable rupee income, helping hedge against the volatile export earning and currency depreciation. Third, cost optimization should be central, strengthening supply chain agility and operational efficiency from lean manufacturing to raw material forecasting can lower production cost and stabilize EBITDA margins. This directly addresses the company deteriorated ROCE, which fell to a negative 51.4% this year from plus 10.3% last year. Finally, a deeper commitment to clean energy and sustainability is not just the ethical move, it is strategic. Their investment of 126 million in solar and biomass is a solid start, but could doubling down here could reduce energy costs, qualify them for carbon credit, and align with ESG driven investor expectations, ultimately improving long term shareholder values. These steps, when integrated into companies' strategic execution, could help reverse losses, regain investor confidence, and rebuild Samsung's position as a profitable export leader from Sri Lanka. Thank you for joining this podcast.